Welcome to the Deep Dive. We're here to cut through the noise of the quarter and really get you the essential takeaways from the biggest earnings calls in medtech. Today, we are diving deep into Boston Scientific, that's ticker BSX. They just had a fantastic Q3 2025. And the story here, pretty clear. Management executed flawlessly. It's a classic, confident, beat and raise.
That sums it up perfectly. Yeah, the call was pre-market and the stock reaction was, well, instant and robust. It tells you the market isn't just happy with the numbers themselves. It signals, strong, renewed confidence in the actual momentum, the underlying business momentum, especially those high-growth platforms.
Okay, let's jump straight into those headline financials then, the ones that really sent the stock moving. Bottom line, profitability looked stellar. Adjusted non-GAAP EPS, that's the number that strips out the one-offs, gives you a cleaner operational view. They came in at 75 cents.
75 cents. Yeah, and that sailed past the street's consensus, which was sitting around 71 cents.
Right, a clean 4-cent beat. Pretty definitive on earnings.
And they backed it up completely on the top line, too. Total revenue, $5.065 billion. That easily beat the consensus estimate of, what was it, about $4.97 billion? But, if you really want to see the operational strength, you got to look at that organic growth number. And that's where the story gets really interesting.
Oh, tell me about it. Year-over-year organic revenue growth hit 15.3%. I mean, not only did that crush expectations, it blew past the high end of their own guidance range. That was 12 to 14%. When a company delivers that kind of acceleration, you know something significant is happening under the hood.
What's fascinating here is how they manage that margin expansion while still dealing with, inflationary pressures and everything else.
Yeah.
Adjusted operating margin expanded to roughly 28%. That's an 80 basis point improvement year over year. Now, okay, there was a small tailwind helping them out.
Ah, right. The tariff headwind.
Exactly. The CFO's team revised the full year tariff headwind down. Is $200 million. Now they're saying $100 million. But honestly, even factoring that benefit in to maintain that kind of margin discipline while growing 15.3% organically, that shows serious operational leverage, serious execution.
And naturally, when you beat the top line like that, you expand margins, you show that kind of strength, you raise the forecast.
They absolutely did. Full year 2025 guidance got a nice bump across the board. Adjusted EPS is now projected between $3.02 and $3.04. That's up from the prior range of $2.95 to $2.99. And for organic sales growth, they essentially baked in that Q3 performance. They're now projecting approximately 15.5% for the full year. It's basically a statement. These growth engines are not slowing down.
Okay, let's unpack this then. Let's figure out where this phenomenal growth is actually coming from. Because it's clearly not across the whole portfolio equally. It's being driven by massive outperformance in specific areas. Their biggest segment, cardiovascular, that was the main engine, pulled in $3.34 billion in revenue and delivered, 19.4% organic growth.
Yeah. And that difference, that gap between cardiovascular at almost 20% and then the med-surg segment, which grew, slower but still steady at 7.6% organically.
Yeah.
That tells you everything. The BSX story right now is defined by category leadership, specifically in structural heart and electrophysiology.
Right. Let's talk about those two giants, starting with EP, electrophysiology. We saw sales there, mainly driven by their big product, FARAPULSE PFA, grow a remarkable 63% this quarter. 63%. I mean, that's just astronomical. Is that kind of rate sustainable? Or are we looking at maybe a temporary peak from the initial launch phase?
That's exactly the right question. And management's message is basically, look, the initial launch curve is super steep, yes, but they believe the leadership position is durable. FARAPULSE, the leading PFA tech. PFA being pulse field ablation. And the key thing, the real moat, is the experience. It's treated over 500,000 patients globally. 500,000. That patient number isn't just big. It represents a massive lead in clinical experience. Physician comfort level. Competitors just can't match that right now. It cements their advantage.
And they got more validation on the global front too, didn't they?
Correct. They secured label expansion in Japan through the PMDA for the persistent AF indication. And that came after strong clinical data like the Paradise 1-year results they highlighted. Look, management is staking a huge claim here. They're aiming to exit 2025 with 50% global PFA penetration, and they're targeting 80% by 2028.
80% penetration by 2028. Okay.
So that 63% growth we saw this quarter, it's just the leading edge, the indicator of that really aggressive goal.
Okay, moving over to the other powerhouse, structural heart. The Watchman device for left atrial appendage closure, that's delivering a similar blockbuster story, grew an outstanding 35% in the quarter.
Yeah, and the key driver there, it continues to be this accelerated concomitant uptake in the U.S.
Concomitant uptake. Remind us what that means exactly.
Sure. It means implanting the Watchman device right after the patient has their AF ablation procedure. Same setting, same time, basically. It's a huge efficiency gain for the doctor and often safer for the patient, too.
Okay. So it's not just about having the best device, it's about optimizing the whole procedure.
Exactly. It's a procedural story as much as a product story. Management feels confident that about 25% of U.S. Watchman procedures will be concomitant this year. And they see potential for that ratio to double, maybe hit 50% by 2028. They call it the trusted fair watch approach because they have the leading PFA device, FARAPULSE, and the leading LAAO device, Watchman. It creates this powerful synergy, this combination and adjacent procedures that's really tough for competitors to replicate.
So even with that acceleration, they're still comfortable with their long-range target for the overall Watchman market growth.
Yep, they reiterated comfort with that 20% compound annual growth rate for the total Watchman market. They think the market itself is growing that fast, and they're leading the charge.
Okay, so cardio is clearly flexing its muscles. But we shouldn't overlook the rest of the portfolio, right? The foundation seems strong. Neuromodulation, for instance, showed a solid 9% growth.
That's definitely a highly respectable performance.
Yeah.
You know, that segment got a boost from the brain franchise. They had positive 5-year results from the Intrepid study for DBS, deep brain stimulation, and the pain franchise is strengthening too. Intercept is driving double-digit growth in the U.S. pain market for them.
And they're still using M&A strategically, looking for those adjacent growth areas.
Right. We saw the agreement to acquire the rest of Nalu Medical. That's about $533 million up front. This gets them deeper into peripheral nerve stimulation, PNS. It's a smart adjacency. Really complements their existing chronic pain portfolio. Trying to capture more points along the patient journey, they think it'll be slightly accretive to earnings by 2027.
And there was another smaller deal that closed recently.
Yeah, the Elutia Bio-Envelope Assets acquisition. That's focused on preventing complications when implanting CRM devices, like pacemakers. Another tuck-in to strengthen a core area.
Now, in a quarter this strong, it's easy to just focus on the highlights. But we should probably touch on the small operational dips, the regional challenges.
Yeah.
Because sometimes those reveal some latent potential.
Good point. We saw an operational dip in EMEA, that's Europe, Middle East, and Africa. Organic sales there were actually down 2%.
2%? What happened there? Was it demand?
No, not a demand issue, according to management. It was entirely transient stuff. Two main clauses. First, the planned discontinuation of their Accurate valve. That product used to do about $50 million in sales, so that's gone now. Second, and this is the frustrating one, a temporary $30 million back order. It resulted from an ERP system upgrade they did in Europe.
Wait, an ERP system upgrade, like a software implementation,
right,
literally held up $30 million in sales.
Yep. You could just imagine the sales team, right? Having orders ready to go, but physically unable to ship because of a system issue at a distribution center. Major headache. Management expects that $30 million back order issue will improve through Q4. It just highlights that the underlying demand in Europe is still there. They just had a short-term supply chain hiccup.
Okay. And what about China? VBP, volume-based procurement, that's still a big shadow over medtech there, isn't it?
It is. It's a significant drag. But China remained highly resilient for BSX. It grew an impressive mid-teens organically, which honestly is a huge win given that substantial VBP headwind.
Remind us again, VBP is basically mandated price cuts?
Essentially, yeah. The Chinese government mandates deep systemic price cuts on certain high-volume devices to control costs. So for BSX to still pull out mid-teens growth against that kind of pressure, highly impressive. That growth was driven by new approvals, like Watchman Flex Pro getting cleared, plus continued strength in their intervention cardiology products, ICTX, and of course EP doing well there too.
All right, shifting gears to the investor context. The long-range strategy seems incredibly durable. And that's likely why the market's reacting so strongly. We know Q4 guidance is solid. $0.77 is up to 79 cents in adjusted EPS. What about catalysts coming down the pipeline?
Yeah, near term, you want to watch for continued enrollment in the AGENT DCB STANCE trial. DCB is drug-coated balloon. This trial is looking at using the balloon in de novo lesions.
De novo, meaning new blockages, not just ones that have re-narrowed.
Exactly. Treating new blockages, not just restenosis. If that trial is successful, it could potentially double the addressable patient population for that specific device. Big potential market expansion. We're also expecting a very limited initial launch of their IVL product, intravascular lithotripsy for peripheral interventions, probably by the end of 2025. So some pipeline progress there too.
And their long-range target, that goal through 2028, it's still one of the most aggressive in the whole industry, isn't it?
It truly is. They reiterated it on the call. 10% or more average organic revenue growth plus 50 basis points of annual adjusted operating margin expansion every year through 2028. It just speaks volumes about their confidence in the durability of the strategy. It's about consolidating leadership in structural heart and EP, and then using these smart, targeted acquisitions like Nalu to keep raising the overall growth floor of the company.
Okay, now here's where it gets really interesting, right? Tying this all back to capacity and where these procedures are actually done. There was a lot of talk about moving AF ablations out of the traditional hospital and into ambulatory surgical centers, ASCs.
Yes, that shift, that's potentially a huge long-term volume unlock for them.
Yeah.
Management estimates that about 40% of AF ablations in the U.S. happen in states that don't require a certificate of need, a concommand.
Meaning it's easier, regulatorily speaking, to set up and run ASCs in those states.
Exactly. Faster path to adoption for ASCs doing these procedures in those markets. And this shift to outpatient settings, combined with the speed and reliability of FARAPULSE compared to older ablation methods, it really reinforces that long-term growth trajectory. See, the ability to shift volume outside the hospital, that becomes a competitive advantage. BSX is uniquely positioned to leverage because their devices, especially FARAPULSE, are kind of optimized for that procedural efficiency needed in an ASC setting.
This is the deep dive, and we are now shifting into our This Is Not Financial Advice segment. Just want to be crystal clear, everything we talk about now is purely a thought experiment. For educational and analytical purposes only, designed to help you stretch your thinking based on the call's themes.
All right, so given the, extreme confidence that management showed, particularly in those two core cardio engines, right? EP with FARAPULSE and structural heart with Watchman, I'm pitching a pretty aggressive leverage play here. The core idea, the thesis, is that the market might still be valuing BSX like a really strong but traditional medical device company, when in fact, parts of it are acting more like a hyper-growth tech platform that's driven by procedural innovation.
Okay, so what's the trade idea?
We go long BSX, but not just buying stock. We utilize a long-dated, deep-in-the-money call option position. Why? Because we're betting on a massive acceleration driven by synergy. The synergy between Watchman and FARAPULSEs, especially through that concomitant procedure trend. Combine that with the volume leverage potential from the ASC expansion. We think that pushes market growth faster than even management's current, maybe conservative 20% CAGR target for Watchman. And what if PFA penetration hits that 80% target faster than 2028? Say it gets there by 2026. This option position is designed to capture that accelerated momentum. It leverages the competitive moat BSX has built in these two huge, adjacent, frankly, explosive markets. It's really a bet that the speed of adoption is still being fundamentally underestimated by the market.
A compelling, definitely high leverage pitch. Betting hard on that concomitant procedure pull-through and that looming ASC volume tailwind accelerating things beyond current expectations.
Precisely. It's about the rate of change.
Okay, so to wrap up this deep dive on BSX, they delivered a very strong Q3, beat handily on revenue and EPS, successfully raised the full year 2025 guidance. And they really demonstrated exceptional operational strength, mostly powered by cardiovascular, specifically EP and Watchman. They are executing extremely well where it matters most.
Yeah, the story is clearly one of category leadership meeting really solid operational excellence.
Right.
But this raises an important question for you, the listener, to think about. We spent some time detailing those sort of temporary hurdles, right? The ERP system glitch in EMEA, the leftover China VBP pressures, how much potential growth beyond that already impressive 15.3% organic number. How much might still be embedded in the core business? Growth just waiting to be unlocked once these transient regional issues are fully smoothed out, maybe in 2026. Think of it almost like pent-up demand, or maybe a truer baseline growth rate that's being slightly masked right now.
That's a fascinating thought to take away. The idea that the underlying growth might actually be structurally higher once those operational hiccups are fully resolved. Something to watch. Thank you for joining us on this deep dive into the BSX quarter. We'll catch you next time.